Fed Chair Jerome Powell says lower inflation will take some time. He made that comment after the Federal Reserve raised its key interest rates by 1/4 percentage point yesterday. This was the Fed's 10th increase since March 2022, bringing the rate to its highest level in 16 years. Let's bring in Anita Hamilton now to talk about the impact of this latest interest rate hike. She's an assistant managing editor at Barron. Anita, thanks for joining us.
Thank you. Good to be here.
So I guess for a lot of people out there, the concern, of course, in addition to all the other things that are out there with regards to the economy, is what kind of effect this will have on their credit card debt. We know a lot of Americans carry a significant amount of debt on those cards. So what are we talking about?
So the average amount of credit card debt is about $5,500 per person. And if you carry debt right now, that's about 20% interest that you're paying annually. So when the Fed raises rates, that means the interest you pay goes up, which means you're just paying more money for the same amount of debt.
Just out of curiosity, do these rates ever go down when the Fed drops their interest rate, or no?
Yes, they do. So back in 2021, the rates were like 16 or 17%, which, is a lot. This is the highest interest debt you're going to get. And the reason for that is that it's unsecured. So let's say if on your house, if you can't pay the home loan, they take your house. Car loan, they can take your car. With credit card debt, there's not a lot they can do. You'll see your credit score go down, but that's why they charge such high rates.
So speaking of cars and mortgages,
cars and mortgages,
because these are the sort of decisions that really sort of change people's lives or keep them kind of in one stage of life.
Yep.
How could mortgages and car loans be impacted by this hike?
So all loans are going to be impacted. What's interesting is this is just a 1/4 point hike, which doesn't sound like a lot, but when you look over the past few years, rates have gone up significantly. It's like 3 to 4%. When you have a home, for example, that can add up to a lot. We did the math on what the increase that you'll pay in your monthly payments for a median home, and it's over $700 just because of interest rate hikes per month.
So as you know, Jerome Powell indicated the process of getting inflation down to 2% as what he said, a long way to go. So what are some of the things that have to be considered for inflation to hit that benchmark?
Well, the goal is just to kind of slow economic activity just enough to keep prices down, to lower consumer demand, but not so much to see mass layoffs and other big problems. So the Fed has left the door open for another rate increase, but they're also indicating that, it may come to an end soon.
So another day, another regional bank is in trouble. PacWest Bancorp is considering a potential sale. That's according to reports. Actually, sort of, when I read, almost like begging for someone to buy the bank. What do you know about PacWest's situation, and why are we seeing a string of regional banks struggling so much?
Well, PacWest just issued a statement late last night, like just after midnight, saying that, as they had previously said, they are looking into strategic asset sales. They are not saying they're selling the entire company, but they're saying they're looking for, a certain chunk of their assets to be sold. The reason why regional banks are struggling is because they have a lot of, many of them have unsecured assets, and that makes people uncomfortable. And that can lead to a bank run. Which can have, more dire consequences for these banks.
Anita Hamilton, thank you very much.